Welcome back to the Financial Freedom Show. My name is Rob Berger, and I've learned something really important today, and that is when you do a live stream, first check with the chat to make sure they can both see you and hear you. So before we get into the topic, which I was halfway through in the last live stream about why dividend investing and dividend ETFs in retirement are, I think for the most part, a bad idea, we are going to let some folks join the chat in this now relaunched live chat, and I can see from Curious Mind you can now hear me. Now, I'll say right from the start, I'm not sure if the fact that you can hear me makes this a better show or not. You may actually kind of regret the fact that you told me you couldn't hear me. Maybe it would have been much better if you couldn't. And a big thank you to Matthew, who alerted my wife that no one could hear me, and then my wife barged in, and I'm sitting here wondering why she's interrupting this live stream. And it's to tell me you couldn't hear me. So there you go. So here's what we're going to do. We're going to try it all over again. I'm going to tell you why I think dividend ETFs and dividend investing in general in retirement is a big mistake. There are a couple of exceptions that we'll sort of talk about, some arguments in favor, but by and large, I think it's a big mistake. And then I'm going to, after you guys make fun of me for not being able to work live stream, and that's fair, I'll answer your questions. And I see folks are now back into the chat. Thank you for your grit, really. I should send each of you a free copy of the book Grit, because you've obviously got it. Maybe you don't need it. Anyway, thank you. So, dividend investing. I'm actually going to have another video that comes out in a couple of days about what I think are some of the better dividend ETFs, and some dividend ETFs I wouldn't touch with a 10-foot pole, and why. This one is a little more specific, though. So I got a question from a viewer. He wanted to know, how do you create a retirement paycheck? I'm going to do a separate video on that, because there's a lot of issues, right? You've got tax issues, Social Security, all these other things. But in his video, he said, look, I can't quite live off of dividends and income, and I'm really not a fan of selling shares. So should I invest in a dividend ETF to generate the income that I need in retirement? I think that would be a mistake. Again, we'll talk about some minor exceptions and ways to think about a dividend ETF. I think that would be a big mistake for retirees. Now, just so we're clear, what's a dividend ETF or mutual fund? I just define it as a stock fund that pays above average dividend yields. I would exclude REITs. They're sort of a different animal. I would certainly exclude covered call ETFs. They make their yield primarily from selling call options. But the point is, there are a lot of funds that don't even really advertise or market themselves as a dividend fund. Some do. They use the word dividend in the title of the fund. We're going to look at some. But if you just look at any value fund, Vanguard or Schwab or Fidelity Value Fund, they're going to pay a higher than average dividend yield. So, but that's what I mean. So these, I'll just refer to them as dividend ETFs for this video. And I think the basic claim for those folks that really are attracted to this sort of investing, they say, look, particularly in retirement, it's much better to live off your dividends and income rather than selling shares. That's the basic claim. That's the idea. And I'm going to give you my reasons for why I think that's not correct, actually. So I want to break down. I've come up with some reasons why I think people believe it's better to live on dividends than sell shares, and I'm going to respond to them. I see the chat. I'm glad you can now hear me. I'm sure you guys are going to fire me up in the chat with your questions and why I'm wrong, and that's okay. I hope you do. We'll look at those in just a few minutes. So, number one, I think sort of the basic idea, right? It's better to spend dividends since selling shares reduces your ownership, right? And that has some intuitive appeal. You own 1,000 shares of S&P 500. I'd much rather have the dividends rather than having to say, whatever, sell 50 shares to live on. We feel like, we've lost less when we just spend the dividend. Here's the problem with that. I've talked about it in the past. There's actually a word for it, a term for it. It's the free dividend fallacy. It's this idea that dividends are kind of free. We still own whatever we owned before the dividend, and we get this dividend, and it's, it doesn't affect our ownership. The problem is it absolutely reduces the value of the company or the fund. No question about it. And in response to that claim, what a lot of folks say is, well, no, Rob, I've had many times I get a dividend, quarterly dividend, and the price of the stock or the fund actually goes up. And it absolutely does. But you have to understand why. First of all, a quarterly dividend of a company or an index fund, an ETF, is a very, very small amount. I mean, they're, even like an Apple, they're giving away, not giving away, but paying a dividend that's a very, very tiny portion of this, $2 trillion company. And there are other things going on on a day-to-day basis that will influence the current price of a company beyond the dividend. If you think about Apple, just as an example, you've got what's going on in China, chip shortages, interest rates are going to affect it. What's going on in India? Is the iPhone 13 a hit or not? All of these things in the short term are going to be much, much more important. But over the long term, as companies pay out billions of dollars in dividends, it absolutely reduces the value, the intrinsic value of the company, and that's ultimately what will drive stock price. And in fact, there's even an argument that when a company pays $1 in dividends, their intrinsic value can go down by more than $1. And you might say, well, that doesn't make any sense. Well, keep in mind, many, I'd say maybe in most companies, trade at a multiple of their book value. Apple currently trades at like 36 times their book value. That's a bit of extreme. But they trade at a multiple of book value. And so some have made the argument that you actually might lose more than that dollar from a dividend. And you might, at this point, you're saying, Rob, let's be honest. Appreciate what you're doing, but you're just an idiot on YouTube who doesn't know how to work your microphone. Guilty, fair enough. But there's someone else who's made this claim. And he is not an idiot on YouTube. And I'm going to show you who it is. Let me see if I can work my computer. See, I'm all been out of shape because of the whole sound thing. But I'll recover. Here we go. So let me show you on my screen. I'm going to actually backtrack. This is Berkshire Hathaway, fancy website. And here's the Warren Buffett letters to Berkshire shareholders. Online, you can go back to 1977. And you want to zero in on 2012. Here it is. Let me make it a little bigger for you. See, I can do that. And we want to scoot on down to page 19, I believe. Let's see. Here it is, page 19. Yeah. And it's conveniently labeled dividends. In all seriousness, I know I kind of joke a little bit here and there on different things in this channel, but you really ought to read this. Warren Buffett has a way of educating folks about investing that's just clear and concise. Even if you end up disagreeing with him, you shouldn't agree just because it's Warren Buffett. I mean, you probably want to give him the benefit of the doubt, I would think. But, you need to make your own decisions. But he walks through the idea of generating income from dividends versus selling shares. And I highly, highly recommend this. All right, so that's point number one. Number two, the idea is, you got to sell shares in a down market. Isn't that exactly what we don't want to do? We don't want to, it's like buying high and selling low. If the market's down, we might not care about a 1 or 2% drop in a year as a retiree, but if it's down 10, 20, 30%, who wants to be selling shares? I'd much rather live on dividends. But when you start to think about the mechanics of generating income in retirement, what are you going to do each year with your portfolio? Well, I think you're going to rebalance, right? And so you might be 60-40, 60% stocks, 40% bonds, could be 70-30, even 80-20. In a down market, even if you pull all of your income for the year from, say, a stock ETF, you're going to rebalance. And in a really bad market, what are you going to do? You're going to sell fixed income bonds, right? And you're going to buy stocks. And so in a down market, just the act of rebalancing every year will make you a net buyer, not seller, a net buyer of stocks, which is one of the reasons I find the bucket strategy, which I've talked about in the past, to be totally unnecessary. I originally liked the idea, and part of the reason was, I'll have all these cash buckets that'll act as a cushion so that in a down market, I don't have to sell stocks. But if you just rebalance every year in a really bad stock market, you're going to be a net buyer of stocks because just, rebalancing. All right. Number three, kind of related to number two, but it's the dividends get paid out even in a down market, right? And so market falls by 30%. Yes, some companies might cut their dividends. They did that in the Great Recession. They did that in 2020 during the COVID downturn that lasted, like 3.5 weeks? Anyway, and that's true, but you'll still have some amount of dividends, and you can live on those in a down market. But again, I would go back to points 1 and 2. Dividends aren't free. They're going to lower the intrinsic value of your investments in the long run, which is why I believe total returns are vastly more important than just focusing on the dividends, as much as I love the dividends I get. And point number 2 as well, in a down market, you're going to be a net buyer of stocks. So I really don't think the fact that companies continue to pay dividends in a down market is a strong reason to focus on dividend investing. Now, keep in mind, I'm not running from dividends. I'm not trying to avoid them. The question is, should we try to increase our yield and run towards the dividends? Now, before we go to point 4, this is one area where for some folks, having a slightly higher dividend can help you. And it's for the psychological benefits. I get it. Particularly as a retiree. I guess I'm kind of semi-retired maybe. You're scared of running out of money. And in a down market, the fact that you're getting maybe above average dividends might help you stay the course. It might help you grit your teeth, stick to your whatever 70-30 portfolio and rebalance by buying more stocks even as they crater. You could get some psychological benefits from having a slightly higher dividend yield. And if that's you, I'm not here to talk you out of that at all. I think those are real. I think our psychological approach to money, for math nerds, they're like, that's just, it's just numbers. And I kind of lean that way myself. But no, there's an emotional side to money. And trust me, when you start to retire and you're afraid of running out of money, that's a serious part, of having gray hair is the emotional side. So there is a psychological benefit to maybe higher dividend yields. And we're going to look at some examples in a minute, but I will say that could be a reason to maybe increase your dividends. And I'll show you a fund that I like. But you got to be careful, because at the end of the day, what's going to actually determine how much money you have and how much you can spend in retirement is going to be total return, not your dividend yield. All right. The fourth argument, and the final one, and then we're going to look at Portfolio Visualizer for a second, is that dividend-paying stocks are less volatile. They don't go up. They go up and down. We all know that, but they're not crazy. They don't. It's not as wild a ride. And I kind of always sort of accepted that. It's true. But as I started to look at it, I'm not so sure it's true anymore. And let me show you my favorite dividend ETF, and it's one that many of you I know invest in, and it's the Schwab US Dividend Equity ETF. In the video that's coming out in a couple of days, hopefully the sound works on that video, I'm going to talk about why I like this so much. But in any event, here it is, and we can look at the yield for just a quick moment. And we can see here it's 2.82%. That's the 12-month yield. The SEC yield is a little higher. That's the annualized yield looking at just the last 30 days. And it kind of makes sense that it's higher if many of the companies in the index are increasing their dividends over time. But in any event, we'll call it 2.8, 2.9% yield. You compare that to the S&P 500, I think Vanguard's S&P, I think is around 1.2. So you're talking 2x, 2.5x the yield. Now, let's actually compare the two. So I'm over at Portfolio Visualizer. I've put in, this topic is for retirees. So, in the chat, you may want to talk about it from a 20, 30, 40 something perspective, and that's great, we'll cover it. But what I've done is, I've got $1 million. We're going to withdraw a fixed amount. We're going to do 4% in year one. We're going to adjust it for inflation. We're going to rebalance annually, and we're going to reinvest our dividends, which get paid out, so it doesn't really matter, as you'll see in a minute. The dividends, in other words, the dividends won't cover the full $40,000, so we're spending them anyway. And we're going to display the income. And here are the two funds we're going to look at to begin with. There's our Schwab fund, and SPY is just the Spider S&P 500. And we analyzed it, I already did this. There we go. Actually, let me make sure I hit it anyway. There we are. So the Schwab fund, in terms of our final balance, meaning our balance today, it underperformed the S&P 500. Now, this is only 10 years of data. That's how far back the Schwab fund goes, January 2012. So I want to stress that. It makes sense the S&P 500 would outperform because growth has been on a tear, right? And so you think about a dividend-paying ETF, it's really a value fund, is effectively what it is. And so we would expect an S&P 500 to outperform Schwab. And if we looked at a growth fund like VUG, VUG, Vanguard Fund, or QQQ, which is what NASDAQ 100, they're going to clobber them as well. But that's just during a high growth period. Those things change and value can outperform. But in any event, for the data we have, it outperformed. Now, here was the thing that I found interesting, actually more interesting than the final balance. is look at the standard deviation, which is the measure of risk, of volatility. They're identical. S&P is 1 basis point higher. But actually, the max drawdown, right? Schwab actually has a higher drawdown than an S&P 500. That occurred with COVID, as you can see there. And its worst year is actually worse than the S&P 500. So much for dividend stocks being less volatile, at least based on this 10 years and just these two funds. And those are really important caveats. And if we come down to income, we can see, yeah, Schwab definitely pays more income. Neither of them would cover your $40,000 first year. So in both cases, you'd be selling shares. With the S&P, you'd be selling more shares, right? And that's true every single year. And that might be uncomfortable, right? We don't like selling shares. But if we did that, at least for these 10 years, we would come out at the end with about $3.5 million versus 3.1 for Schwab. And that's the thing I really want to stress, is that at the end of the day, yes, there's psychological factors, they're important, good, but at the end of the day, it's total return that's going to drive all this. Now, you might be saying, well, Rob, I got two problems with this. One is Schwab may be great, but what about a fund that actually could pay at least 4%? Maybe that would do better. We'll look at that in a minute. And the second thing you say is, well, again, Rob, you pointed out this has been a growth decade. So wouldn't this just reverse if the next 10 years are a value decade? Absolutely. And in fact, that's the second sort of argument I could see for anyone, but certainly retirees, investing in a fund like the Schwab fund. And that is, valuations are extremely high. The Schwab fund has a much lower average PE and price to book. All the value metrics are much lower than, say, an S&P 500. And if I were going to bet, I would say over the next 10 years, the Schwab fund will outperform the S&P 500. That's my guess. Am I right? Will I be right? No earthly clue. In 10 years, if I'm still doing this video, someone remind me, we'll call it 2030. Someone remind me that I made this claim, and we'll get on Portfolio Visualizer and just see how wrong I was. So I could see the argument that says, Rob, I'm not going to go all dividend investing, but I like, say, a fund like Schwab, and I kind of want to lower the overall PE and price to book of my portfolio sum right now. So I'm going to allocate some to, say, a Schwab. I got no arguments with that, and I've considered doing the very same thing. I haven't done it. Will I do it? I don't know. I think that's a valid argument. The key, though, is keep in mind, that argument has absolutely nothing to do with the dividend yield, right? It's the fact that it invests in value-oriented companies, and you can see that visually real quick. If we go back to Morningstar and we go to the portfolio, see the blue dot, and it's under the value column, right? S&P 500 would be a blend. The QQQ would be over here in growth, so would VUG. But Schwab is squarely within the value, and you can see its price earnings. Now that's a forward PE. It's trailing 12-month PE, I want to say, is around 19, but the S&P 500 is what, like 30 or 32? So absolutely, I could see a value argument here, but again, it has nothing to do specifically with the dividend yield. It's just that value and dividend kind of go hand in hand. That's just because they're older companies that have been around longer. So there you go. Now, I mentioned, could we find a fund that pays a dividend yield of at least 4%? Let me finish with this, and then I'll turn it over to you guys, and you can ask me whatever you want. So the fund we're going to look at is the Global X Super Dividend ETF. So this isn't a dividend fund. This is a super dividend fund. Look at the value. I mean, it's mid cap, and it's not even on the tic-tac-toe board. It's like all the way over here. And if we go to the quote page, its yield, I think, is like 5.6, maybe. Let's see. No, 7. Oh, that's the global one. Yeah, it's 7.19. Actually, I want to use a different fund now that I think about it. It's a sort of a sister fund, and it just focuses on the U.S., but it still has a hefty dividend. 5.61, so well above, say, 4%. By the way, the other one actually performs worse than this one. They're both pretty bad. I'll just so don't feel like I'm cherry picking. I just wanted one that focuses on U.S. stocks, since that's what we're looking at with Schwab and the S&P 500. And you can see, yes, U.S. equities 90, we'll call it 98%. Still very value, mid cap, so that's div, and we can add it. It's right here. Actually, there's the SDiv, so we can look at both if you want. But I'm going to put 100% into the div fund and rerun the numbers. Yeah, the div fund doesn't turn out very good, does it? Now, by the way, it's a shorter time period. I think 2014. Yeah, just because that's the data we have. That's what we're limited by, and that's a very important caveat to keep in mind. But I mean, here's the other thing. Not only do you end up with a much, much worse result, look at the standard deviation. So much for these dividend funds being, not volatile. Look at its worst drawdown. It's more than twice the other two funds. And its worst year, I mean, look at that. It's absurd. And if we go down, I want to show you actually down here. Yeah, it's generating all this income. Although look how unstable it is. It's up, now it's down, down again, up. It cratered in 2020. We're still in 2021, so who knows? And look at this. In year one, you didn't have to sell a single share because it generated, I don't know how well you can read that, but it's almost 61,000. And we're starting off at 40, adjusting for inflation. So you may never had to have, I don't know, probably by 2017 you had to sell some shares. But again, that's why I stress it's total return. That's what you've got to focus on, not the dividend yield. So thanks for hanging in there through the old audio fiasco. Audio gate, is that a thing? But for those that did, and those that watch this video later, that's my take on dividend investing. Frankly, it applies not just to retirees. It's just that with retirees, somehow dividends make us feel all warm and cozy. And I'm not so sure they should. Again, can maybe make the argument on a value basis. I get it. And I've invested in value stocks in the past that paid a higher dividend. But again, my focus was on valuations, not the dividend yield. So there you go. That's my take. And now I guess it's your turn. So let me go back to the chat. And again, thank you for hanging in there with me. And we are back, says Freebird. Okay, take two. Hello. This time there will be sound. Check. Thank you. Don't say test. Okay, let's see. So you guys can hear me. Good. Vinyl says we were taking bets on how long it would take you to notice. So here's the funny thing. Of course, you didn't hear any of this. Let me just show you this. I'm going to show you behind the scenes, if I can, what my setup looks like. Who wants to see my YouTube setup? All right. See, so I do have some technical skill. Okay, maybe that's an overstatement. There we go. So I have a teleprompter. There it is. You've probably guessed that I don't read. Oh, look at this. Now my iPad is saying low batteries. You've probably guessed that I don't read my YouTube videos, and that's true, but I'll have notes. And so those are my notes right there. And over here is the chat that I'm looking at. There's the chat, right? So when I was doing the first version, when you couldn't hear me, I could see the chat. Let me just go here. I could see the chat over here just going nuts, but I wasn't reading it because I'm focused on my presentation. And I made the comment, I said, I bet all that chat, you're just disagreeing with me left and right. And of course you weren't. You were telling me, Rob, you're an idiot. We can't hear you. Oh, by the way, so if I show you this, so I got a monitor over here. That's the monitor you see when I push that button. And that's the streaming, the video streamer where I can control all of this. And then I got my PC over here, and that's my, can you see? I can't get the cord won't stretch. There we go. There's my gaming PC. And there it is. So that's my setup. We are reading your hand signals. Thanks, Salty. Okay. Dan says the wife should get a gift. Dan, you have no earthly idea. Okay. Oh, Vinyl says, as I said before, I'm a big retirement dividend investor, so this will be interesting. Here's what I'll say on that. If you're investing, like if you think about Schwab, yeah, it has a higher yield. It's not an insanely higher yield, right? So if the average yield is whatever, 120, 130, 140, and you're getting 2.5, maybe up to 3, you're probably going to do okay, is my guess, as long as it's a low cost, index kind of fund. When you get to 4, 5, 6, 7%, in order for a fund to get that kind of yield, and remember, this is a weighted average yield, you're investing in things that are, I think, very unlikely to outperform the market as a whole. There's a reason why they're paying that much in a yield. So again, and I hope I made that clear in the video, anyway, or the first part of this video. Vinyl has 39 different stocks. I don't know how you do that. All right. Scott says, love to hear why dividends are not a good idea right now when they're reinvested in tax-deferred account. Well, so keep in mind, like my taxable accounts generate dividends, right? And at the moment, I'm not reinvesting them because I'll probably spend some of them, and I'm working on my asset allocation, where I'm sort of reinvesting them, if you will, but in retirement accounts. But if I were 30, 40, if I were younger, I guess, and not getting near retirement, yeah, I would absolutely reinvest my dividends in my taxable account. Did that for years, absolutely. I tend not to automatically invest them because there's no reason to, and the tax issues, and I might want to invest them in a way that helps me rebalance. But I would absolutely reinvest them. All right. So Vinyl says dividends may increase the value of the company since management has limited money to invest in foolish schemes. I don't disagree with that. You want management to allocate its capital in the best way. And so they invest in new products. If it's a good investment, great. They might do share buybacks, which are a much more tax efficient way to return a value to shareholders, assuming they're buying at prices that are reasonable. That's a big assumption. And yeah, to me, the dividend would be the last thing. They don't have anything else to do with the money. They should pay a dividend. I agree with that. Absolutely. All right. I disagree with the idea that Apple is throwing away a lot of money in buybacks. You could argue, you could argue there may be a little overvalued right now. Maybe. I don't know. It's a cash cow. Apple is dead money. All right. So I think just about everyone disagrees with me, and that's okay. Tyler says, Rob, I always felt like you give sound, and that's in all caps advice. See what I did there? I sure do, Tyler. And I'm getting hot, so I'm going to take this off, and you get to see me in a t-shirt. My wife's going to be so upset with me. Okay. They're interesting comments. Warren Buffett owns the whole company. He has access to the entire cash flow for reinvestment. That's true. As does, every CEO and their board. That's all right. So Vinyl also says if you're a small investor and you don't own the whole company or a majority of it, then you only have access to the dividend. You don't control how the company allocates its capital. Obviously, if a dividend is paid, you get your share. That's true. I don't know if that changes the equation. I mean, I tend to invest only in dividend-paying stocks, with the exception of Berkshire, but that's more, again, it's an evaluation reason. JP says, thanks for your insight as always, Rob. I was going crazy thinking about how to set up this bucket strategy until listening to you simplify. Thank you for your service. And yeah, I went through the same thing. I just assumed I would use the bucket strategy. It had some initial appeal. And then when I started to try to implement it, it made absolutely no sense whatsoever. Dan says, why do companies pay out dividends? Well, I mean, I can tell you why they should, right? I kind of alluded to it earlier. You bring in profit. What are you going to do with it? Well, you've got to fund your ongoing expenses. Well, your expenses come from your cash flow, assuming you're profitable. But you also have to keep money on hand. A company needs an emergency fund, just like you and I do. but they also for capital reinvestment, right? I mean, eventually Ford has to replace its manufacturing equipment, or UPS has to replace its trucks. And those don't get expensed every year. They're capitalized and then depreciated every year. But you have that investment in the company. Maybe you want to do some research for a new product. You want to expand, open up new locations. You might do some acquisitions if they make sense. You might buy back shares if you can buy them back at a reasonable price. And then when that's done, you should pay the dividend, right? You should basically, a dividend, the way I think of a dividend is the company, I picture Tim Cook saying, Rob, we're doing great here, making a lot of money, but we've got so much money, we can't do anything with this portion of it. So here you go. We can't invest it for you. That's what we're doing. We're investing your capital. We can't invest this for you. Have it back. Yeah, that's how I think about it. All right. Let's see. So Eric has a couple of questions about my setup. What teleprompter size is it and what tripod is it on? So it's a 15-inch teleprompter. And you know what I'll do? I'll put together a list in Amazon and I can share it with you. I don't think I have that on there. The tripod, I mean, it's a basic tripod, but I don't know the brand. But I'll get all that for you. The camera is just a Sony, I think A4 or 5. And, it's like an $800 camera. It sits obviously behind the teleprompter. And it's a basic lens. I think it's a 16 millimeter. I'm pulling up my Amazon account. I have a list here, but I don't know if I have that list. Let me just see. Because I have a list called My YouTube Setup. The lens is a Sigma 16 millimeter. It's a Sony Alpha A6400. I don't have the teleprompter in there though. I'll add that and then share that link maybe next week. So Bob says in an IRA, taxes on dividends don't matter, don't enter. Total return is the only thing that matters. Yeah, I mean, at the end of the day, I think it's the only thing that matters in any environment. But right, I mean, in an IRA, you don't pay taxes on the dividends, at least when you earn them. That's absolutely true. Michael says he has 68 different stocks. I think you have more than Berkshire Hathaway has. I don't know how you track all that. I have 4. Here would be my question. Can you name the CEO of all 68? Have you read the latest 10K or Q from all 68? Have you listened to the latest earnings call? And I'll be honest, I can't answer that affirmatively for just the 4 stocks that I have. Now, they're very well-known companies, and I read about them all the time on the news, but I don't always go in and listen to the earnings calls, and I should, frankly. Richard has, I don't know if that's a ticker he's given me. Let me look it up, and if it is, I'll show it to you. Yeah, it is. Oh, that's on that. So he says, Richard says, CLM, let me show you on the screen. Here it is. 15% dividend. Well, so I don't even know what this is at the moment. And it's not even a value fund. They must be selling options. Hang on for a second. Let me pull it up in a different way. Well, it's closed in. I'll show you what I'm reading. I wonder if it's paying back some of your investment. I mean, because there's just no way it can do that. This goes back to 2012. So it's significantly underperformed, at least Schwab and the S&P 500, and it's got a huge, standard deviation, higher max drawdown. So this is just an initial look at it. That's interesting. I wonder why. Oh, that's annual returns. Here we go. Yeah, so its income, of course, is ridiculous, right? It must be paying back some of the investment, because I didn't see here that it's selling options. So I can look at this more closely, and maybe someone's more familiar with it than I am. My guess is it's paying back some of your capital, but I don't know. That's just a guess. As I get lower in the chat, maybe someone will have answered that. But at least based on the last decade, it's not done particularly well. Really, the way I see a big dividend yield is a red flag. If you see anything over 3%, at least should raise questions. Anything over 5%, and that should be a big warning. Here's a great question that I've thought of before, and I'm not sure I have an answer yet, but it's from Peter. And he says, does it make more sense to contribute to a regular brokerage account if you're close to retirement because you're not going to be taxed at ordinary income? And so the idea is this, you put money in a traditional IRA or 401k, and when you pull it out, you get taxed at ordinary income. In contrast, if you put it in a taxable account, assuming you hold it for more than a year, capital gains will be long-term. And I think for most funds, the dividends are going to be qualified dividends. So you're going to get, they're going to be taxed as long-term capital gains as well. My hunch is it doesn't matter. That's my initial reaction to that question. And here's why. Part of it might depend on when you retire. But if you retire at 65 and you've put it in an IRA or 401k, you've presumably got a lot more money than just the last year's contributions, and you might, so money's fungible at that point. But what you're pulling out, you might not spend that money for years. Even if let's say you opened up a new IRA and you put it right in, and you pulled it out right away. First of all, there'd be very little gains, right? Either way, there'd probably be very little gains. And actually, if you pulled it out within a year, you'd be taxed as short-term capital gains anyway in a taxable account if there were any gains. But it's an interesting question, and I'm going to make a note of that and look at it more closely and think a little bit more about that. Yeah, June kind of makes the point that I think I made. Dividend investment is usually fair value. Better value than growth investment. In a recession, growth stops. So in a bear market, you are still afloat. That's the argument now, that interest rates are very low. We've had a growth market for a decade or whatever. Stocks are at an all-time high. The likelihood that that's going to continue, we don't know when it's going to end, but it's going to end at some point. And won't value stocks outperform? To me, that is a sensible argument for allocating some amount to Schwab, or another good dividend ETF. The real key and the thing to ask yourself is, whatever you choose, can you stick with it for at least a decade? I think a lot of people can lose money constantly shifting from one reasonable asset allocation to another very reasonable asset allocation, because there's an endless number of them. There's a lot of different reasonable ways to allocate your investments, particularly in low-cost index funds. But if you're constantly shifting from one approach to another, yes, I want REITs, no, I don't. I want small cap value, no, I don't. I want emerging markets, no, not today. I think you could do yourself a lot of harm. That to me is the key. Can you stick to it? Fast Eddie, Rob, have you talked about the barbell withdrawal? I haven't, and it's in my list to do. And I'm just looking up, because I think Kitses talks about this, I think. Maybe I have that wrong, but I haven't yet, but it's on my list. I will. Vinyl says most sharebacks are done by idiots. See Bed Bath & Beyond and IBM. Well, yeah. I do think many companies overpay to buy back their shares, and they do that, I think, in part to enrich themselves and management who have stock options. So it's definitely an issue. Unfortunately, our tax code favors buybacks over dividends. Honestly, I won't get into taxes because that'll get too political. All right, let's see what else we've got. What about REITs? They're built for dividends. Well, yeah, they are, because so corporations are taxed on profits, right? And then when they pay a dividend, we get taxed. It's double taxation. REITs don't. If they pay out at least 90% of the income, they don't pay taxes at the sort of the corporate level. But the government is going to get its money one way or another. So the way it does is it forces them to pay out 90% or more. And then for us, we don't get qualified dividends. It's all ordinary income. So the government's going to get their money one way or another, and that's what they do. And there are some great REITs. Check this out. I was looking at this the other day. Let me show you this. We'll change this to O. Maybe. Is it going to show up? Realty income. Here it is, right down here. So of these three, now let's see, it goes back to 2012. So we got Schwab's Dividend ETF, we got S&P 500, we got Realty Income. Which one do you think outperformed? I probably gave it away. I didn't. 2.5 million, underperformed. But it's still a good REIT. It's done very well. And in fact, let me show you something else. That, if we get rid of, let's see, Schwab's holding this up. So let's get rid of Schwab for a second and see if we can get more data. Okay, so now it goes back to 1995, and we're comparing it just to the S&P 500. Hello! What? I think Portfolio Visualizer is broken. Look at that. Yeah, O's done really well. They call themselves the monthly dividend company or something like that. They invest in buildings like for Walgreens or that kind of retail. I mean, they may have other things. And you own shares. You might not realize it, but if you own most indexes, are going to have shares of that REIT. But yeah, REITs can be a good part of a portfolio. Because they pay out so much in income, they often don't have great growth compared to an S&P, although their expected returns are comparable, I would say, to stocks. I wouldn't count on Realty Income reproducing those crazy gains I just showed you. What we saw for the last 10 years, they underperformed. So, but yeah, $1 million would be worth $32 million today. And that's taken out 4% adjusted for inflation. Let me get rid of that for a second. $44 million. Yeah, that ain't bad. All right. You guys are great when I'll start taking clothes off. Trust me. It ain't what you want to see. All right. David says, thank you, Rob. Your other recent dividend video is what made me subscribe. Well, I'm glad to hear that. Like I said, I'm coming out with another one. I've already recorded it. And there's going to be an article with it. It kind of talks about what we've talked about today. It's just not specific to retirees. And I look at a couple of other dividend ETFs, and there you go. So Akeem says, if I allocate the monthly amount to investments, to the different equity types, will it make sense to rebalance every year? If I understand your question, you're saying that each month, as part of making your investments, I don't know, do you rebalance or do you just make your investments based on the asset class that's maybe lower? I'm not sure. And there's a couple of different ways to rebalance. You could just do it annually, kind of like, or every 6 months. I think annually is fine. There's an argument that you don't want to rebalance too often because of momentum. But you could rebalance once a year. But another way is to look at how much they've moved away from your target allocation. And there I like to use a 20% number. So what I mean is And they call this opportunistic rebalancing. You can Google that. There's an article on it, and I need to do a video on it. But let's say you've got 50% allocation to U.S. stocks. Well, you'd take 20% of that, so that'd be 10%. So you'd create a range. So you'd add 10% and you'd subtract 10%. So if your allocation is 50, you'd have this range between 40 and 60. And as long as your U.S. allocation is between that range, you're not going to rebalance. If it goes above 60 or below 40, that triggers the rebalance. And if it's in a taxable account, because of tax issues, you would still rebalance, but you don't have to get it back to 50. You just have to get it back halfway. In other words, if you go above 60, you'd want to get it back to 55. And if you go below 40, you'd want to get it back to 45. It's kind of close enough. It's called opportunistic rebalancing. That's the idea behind it. You don't have to use those exact numbers. And so you could do that approach. Yeah. But I mean, does it make sense to rebalance every year? I think it might. If you're rebalancing every month, then you wouldn't need to. But I don't think that's what you're doing. You're just using your investments to kind of get closer to your target allocation. That's how I read your question. If I got that wrong, let me know. Vinyl says, so we would conclude that Rob thinks Berkshire can invest the money better than he can, which may or may not be true. Well, yeah, certainly, obviously, Warren Buffett is a better investor than I am. Even saying that sounds so stupid. It's like saying, yeah, LeBron James, he's a better basketball player than I am. He has some issues, though, right? I mean, he's got too much capital. He said that. I mean, if you gave Warren Buffett $1 million, trust me, he'd crush it. You give him, $150 billion, and he's got. That's a hard thing to do. That's why, by the way, actively managed funds that really outperform run into trouble, because like ARK, everyone rushes to it. They get billions of dollars to invest, and they can't keep up. They can't profitably invest that much money. But yeah, I trust Berkshire, at least with the amount of money I've invested in them. Sure. Reeked, if I'm pronouncing it right, is there any worth in investing in bonds these days as a 25 to 30-year-old when interest rates are so low? Yeah, I think so. Actually, I do. I mean, could you make the case of a 100% stock portfolio? Sure. If you're 25, 30, other than the COVID, thing, you probably didn't live through the Great Recession as an investor. So it's easy to look at bond yields and say, yeah, I'll be 100% stocks. Then how are you going to feel when they're down 50%, which is what they were down in the Great Recession? I think bottoming in March of 2009, I think. And the other thing, and you might say, I'll be fine, and that's great. The other thing to keep in mind, though, is like a 90-10 portfolio can outperform a 100% stock portfolio for a long period of time, a decade or more. So again, it goes back to what I said over and over again. The question really is, what can you stick to? What can you stick to no matter what? So B says, SCHD, I have this in the value portion of my portfolio, yes or no? Well, if you're asking me, is it a value fund? It absolutely is, right? And we can look at why I say that. Here it is, and you can just go to Morningstar, go to the portfolio tab. There it is, right there. And as a comparison, so there's the 14.98, that's a forward earnings. Let's look at just an extreme different fund, Vanguard's Growth Fund, and go to portfolio. It's all the way over here in the growth column. Price earnings is 33. Those are extreme examples, right? We could look at an S&P 500, and it's going to be in the middle, probably closer to growth though, actually, than value, but still in the middle. Yeah, here it is. And its price to earnings is 21, right? So yeah, I mean, the Schwab fund is categorized as a value fund. I think most dividend funds have to be. I don't know, can anyone think of a fund that would be in the growth column in Morningstar, but pays an above average dividend yield? Now, it can't sell covered calls, that doesn't count. I don't know, if anyone knows of one, that'd be cool. I don't know of one like that. But they could exist. Here's an interesting comment from Mike. He says, I think dividend growth with a long history of distributions would address a lot of risks Rob identified, and Vinyl responding, or to someone else maybe, but said, keep going, you will get $6,200 a month someday. A lot of folks use dividends as a motivating factor. They track them. This is how much I get paid each quarter, each year. And it's fun. It's kind of like the payoff, right? And I think that's great. I'm not here to spoil anyone's party. Kind of sounds like I am, doesn't it? I really am not. I'm like that uncle at Thanksgiving. Everyone's like, why did we invite him? But seriously, there's other channels on YouTube. What's his name? Joseph Carlson? Some of you guys will know this YouTuber. He's got a big channel. Hang on, I'll pull it up. Carlson, right? I think he puts his yeah, here he is. Let me show you. He's got over 200,000 subscribers. He puts his, I guess that's his portfolio balance. I don't know if it's 100% of his investments, but he puts it right there on the thumbnail. But he I think talks a lot about dividends and tracking them. And hey, if that gets you excited, it gets me excited. I like the dividends. It's just that I try to keep everything in context. But I think it's great. I'm not here to talk you out of that. Do I read annual reports and financial statements like Buffett? I do of the companies I invest in. He reads annual reports every day, including companies he'll never invest in. I will tell you that they're fascinating to read. The last one I read was Microsoft. And what amazed me about Microsoft, I don't have any direct investment in Microsoft. They basically have tracked their performance in three categories: business, personal, and cloud. And their cloud now is more than the other two. It's like 60 billion maybe. And it's amazing to think that didn't even exist a few years ago and now represents a third or more of their business. But you can learn a lot about business and the economy and markets from reading 10Ks. And they're dense, but you don't have to just read the management discussion portion. That's all you need to do. I mean, unless you're we're trying to tear it apart and really think about investing in it. Victor says dividends equal profit sharing. Yeah, I mean, absolutely. Dividends are paid out of profits. No question. And there is a sense of connection with management. We're like in this together. You know what I mean? I get that. And there are some companies like Google concerns me, or Alphabet, because they got a truckload of cash and they ain't paying it out. What are they going to do with it? And I get worried about Apple, like the whole self-driving car thing. I don't know. See, eventually that's going to be a commodity, right? Eventually it's going to just happen. Cars are going to be electric. And then it's not going to give a company an advantage. Jack says, I use SCHD for some value exposure, but it's just 100 stocks. Any recommendations for a second value fund? No, not off the top of my head, but that's a great question. In fact, I'm going to make a note. I'll do a I'll do a best value fund video. I get a little nervous because best is such a loaded word, but I'll make a note to do that. Back in the day, I invested in Legg Mason Value Trust. That was Bill Miller's fund. This was the 90s. It's a great fund for a while. And it was a value fund until it wasn't. I invested in Apple when it was a value stock. Sure, I think I've got, so Frank wants to have a video on factor investing, which I thought I will add that. Yeah. It's not something I do, but I'm happy to talk about it. So Mel says, new to dividends and from individual stocks, is it normal for them to be dollar per share. I know a company that prides itself on raising its dividend every year, but that is dollars, not percentages. It's independent of the share cost. So yes. So when you think about the dividend aristocrats, those are the companies that have raised their dividend every year for the past 25 consecutive years. And it's something I talk a bit about on the video that's coming out next. It's dollars. And if you think about it, it has to be, right? Because the company can't control, at least not completely, the price, right? The price is going to go up and down for a lot of different reasons. So you could have a situation where the yield goes down, but the actual dividend payout goes up, or the other way around, right? When stocks crater by 50%, the yields go up, even if, well, not if they cut the dividend, but even if they lower the dividend, right? Depending on how much they lower it and how much stocks go down, but yeah. And at the end of the day, you can't live on your dividend yield, right? If you're going to be focused on dividends, you're going to actually live on the payout, the dollars, right? So. Paul wants to know, does your opinion vary on dividend ETFs that have a variable dividend versus building a portfolio of individual dividend aristocrats which have a constant dividend for someone living off dividends in retirement? No, it really doesn't, Paul. Keep in mind that companies fall out of the aristocrats, right? I mean, they fell out in the Great Recession because they had to, cut their dividend. And of course, companies get added. And so even if I were to invest in all of I think there's 65 in 2021, maybe, something like that. If I were to invest in all of them, I might take a dividend cut, depending on, the economy and what happens, and some of them will fall out of the dividend aristocrats. So, and at the end of the day, what I'm still focused on is total return. And this is actually, I cover a fund in my next video that's a dividend aristocrats fund, although they invest in companies that have raised their dividend every 20 years, over the past 20 years rather than 25. I think that's just to get more companies because their fund has about 113, as I recall. But no, that really wouldn't change my view. Again, I get a yield. I have a dividend yield. I get dividends. I love my dividends. But at the end of the day, what I'm focused on is total return. And in fact, on individual stocks, the last two companies I've bought are Bank of America and Wells Fargo. They both have a dividend, and that's great. But at the end of the day, it's going to be total return that either makes that a good investment or bad one. Tommy says, like I said, buy S&P 500 and go out and enjoy retirement. Absolutely. It's a great way to go. If you can stick to it, yeah, that's the key. But you could do Schwab Dividend ETF and stick to it as part of an overall allocation, and I think that would be perfectly fine. Let's see. Freebird says, I have 12 dividend stocks in a portfolio in M1 and throw 10 grand in a year. I also have a Vanguard low fee mutual fund, I use VTSAX, that I throw 10 grand a year into. I am happy with these portfolios. I think it's terrific. Let's see. Oops. Now and again, this chat, just the interface sends me all the way to the bottom. June says, would you work for a company that's paying no wages to you, but promise to pay you a lump sum to make you a billionaire 30 years later? I think that question is the idea of, would you invest in companies that don't pay a dividend? It's an interesting question, or if that's the point you're making. Because, you could say, well, it's only, for a company that doesn't pay a dividend, the stock is only worth what the next person is willing to pay. And I don't see it that way. And it's an important point because we can compare it to gold or Bitcoin. To me, those are two examples of assets that truly are, you'll get whatever someone's willing to pay tomorrow or whenever you decide to sell. Now, if you pick the time right, particularly Bitcoin, you could be a trillionaire, but there's no cash flow behind those assets. They just sit there. There's cash flow behind Berkshire Hathaway, even though it doesn't pay a dividend, or Amazon or Alphabet. And that cash flow is valuable. I mean, in theory, the idea is, you think Apple's a perfect example. It didn't pay a dividend for 2 decades or more as it was growing its business. And then it succeeded, and eventually it paid a dividend. And that's sort of, you can almost see the life cycle of a company right in looking at Apple. Berkshire is a different beast because unlike Apple, or I think just about any other company, it's really almost a mutual fund, frankly, with the way it's run by Warren Buffett. But here's the thing. What would happen if, for no good reason, Berkshire's price just got cut in half? People didn't want to buy it from you. Economy hadn't changed. Profitability of Berkshire hadn't changed. Just one day you woke up and no one wanted to buy your shares of Berkshire. Well, first of all, I can guarantee you that Warren Buffett would be buying back stock left, right, and center with the 40 billion or whatever he's got in cash. Because the cash flow behind that stock is incredibly valuable. And so it's that cash flow that in the long run is going to determine the value of a company. Now, Berkshire is a little unusual because Buffett owns such a large stake of it, but that would be true if Alphabet tomorrow, for no good reason, the price dropped by 70%. Long term, it would get back to its intrinsic value as the company bought back shares, and frankly, as investors realizing the value of the long-term cash flows, started investing back in. That's my view. So Dave wants to know about qualified dividends. Aren't they a good way to make tax-free income, at least from the feds? Well, it can be tax-free up to a point, right? And you have to have, assuming your total income isn't over roughly 40 grand for singles, 80 grand for marrieds, all you have is qualified dividends up to that point, it would be free. And so if you retire early and you don't have Social Security yet, you don't have a pension, you live off of those dividends, it could be great. Yeah. Yeah, Michael says he supercharges his yield by investing in covered call ETFs. I plan a video on it. The problem I see with it is their total returns. I don't know specifically the funds he's mentioned, but at least everyone I've looked at, total returns are awful. Maybe those are exceptions. I don't know. Let's look at it. I got Portfolio Visualizer. So we'll keep the S&P 500. He mentions, maybe these are great. I don't know. JEPI. That's a JP Morgan Equity Premium Income Fund. And we'll go with his other one, which is NUSI. Let me show you what I'm doing here. Nationwide Risk Managed. I like the sound of that. Who doesn't like managing risk? Get rid of this guy. We're not taking money out. Who knows? Maybe these did really well. Well, January 2021 is not exactly a lot of data. So JEPI. We'll get rid of that one. Let's see how much data we have on the other one. January 2020. Yeah, so it's kind of irrelevant. I mean, it underperformed the S&P, but it's such a short period of time. I guess we'll just have to wait and see how they do longer term. Oh, someone else mentioned those two, but also Swan. So let's go back to Portfolio Visualizer, and we'll change this to Swan. Oh, it's a black swan. It's funny. When I sold my business and I had some money to invest, someone wanted me to invest in their black swan portfolio. And I said, well, help me understand this. You've got a portfolio, black swan, right? Yeah, good. And a black swan is an event we can't predict, right? Yeah. And your portfolio is going to protect me from something we can't predict. Yeah, that's right. Oh, okay. You clearly didn't get the sarcasm in my voice, Mr. Financial Advisor. Yeah, this one just goes back to 2019 as well. So I don't know. Are covered call ETFs a new thing? It's underperformed, but again, it's not that much time. Much lower standard deviation, by the way, so that's good. That's valuable, I think. I mean, again, I'm more focused on total return, but still, that's noteworthy. That's definitely a vote in its favor. Can't argue with that. All right. Let's see. So Sat asked about life insurance products. I'm generally not a fan. Well, obviously, term life insurance. Here's my take. You've got two kinds of insurance: term and permanent, right? Term expires 10 years, 20 years, whatever the term is. Permanent, in theory, will last you till you die. As one might imagine, permanent is much, much more expensive. Why? Because it lasts until you die. Now, think about people you know that are, say, 60 or older, and certainly 70 or older. And no, that doesn't include me. Thank you. How many of them need life insurance? I don't have a single person in my life, family or friend, that I know of who's, say, 70 or older that needs life insurance. Not one. And that, by the way, interestingly, one argument for permanent life insurance is if you have disabled children who you need to provide for after you're gone. And that is certainly a unique situation, and I would absolutely, if that were me, I would consult a financial advisor. I will say that I know at least two families that are my age or older, actually they're both older, who have disabled children. In one case, well, severely disabled, two children. And they actually probably don't need life insurance because the reality is when they're gone, a state program will take care of them. That's just the reality of the situation. I'm not suggesting, by the way, that if you're in that situation, you shouldn't get permanent life insurance. I think that is one case where it could be a good idea. But short of that, people, I don't have life insurance. I don't need it anymore. I did. I had it when we were younger, kids were younger. I'm working. If you don't have anyone depending on your earned income, you don't need life insurance. I mean, some people might get a small policy for a funeral. Okay, but you don't need it. And then when you add an investment product on top of a permanent life insurance, it's like seeing your house on fire and running up with a hose and spraying gas on the house. That to me is, it's just ridiculous. I mean, you could think of a single premium immediate annuity kind of thing where you annuitize some of your portfolio. I'm working on a video I'm actually excited to do because I've come across a formula that can help you determine not only whether you should annuitize part of your portfolio, but how much of it. I don't know how accurate the formula is, but I've found it. I'm going to do a video on it. But yeah, there could be some argument maybe for that kind of thing. But beyond that, any sort of variable annuities, indexed annuities, I don't find them helpful. Everyone talks about the market. What's happening in the market? Is the market blowing up? It better be down a lot. If it's like down 1% and you guys are all talking about the market, I don't understand. What's wrong with this market? Yeah, it's red. S&P's down 84 bips. My Wells Fargo stock is down 172 bips. I don't know. This is normal. I mean, is that even a standard deviation away from the mean? Okay. Let's see. Here's the thing that, June says the market is a casino. I had a friend who said he went all to cash. And I didn't ask him a question that I wish I'd asked him. And it was this: did you also sell your business? Because he has a business. And if you think businesses, all businesses, at least by historical standards, given interest rates, are probably overvalued. So why don't you sell your business? Well, that's different. I control it. Yeah, it's kind of different. But I think the best way to think about investments in index funds, individual stocks, is that you own a part of the business. I get you don't control it. I can't call up Tim Cook and say, Tim, I got your new iPhone. And it's not bad, but why did the cameras stick out so much? Couldn't you have gotten them, I don't know, flatter? Yeah, he's not going to take my call. And he's certainly not going to want my opinion on his dividend policy. So I get that. But at the end of the day, you're investing in a business, and I think that's how you should think about and structure your investments. And unlike a private company, I own a company. My websites and this YouTube channel are owned by a company. I don't get daily people coming in and offering me to buy it at a certain price. But that's exactly what you get with Wells Fargo or whatever. You can come over here and you can see the price. Here it is. It's going up and down by the second. Here's our daily. There it is, right? And that, I think that causes the ability to see that and to push a button and buy or sell causes us to treat the stock market differently than we do, brick and mortar businesses around the corner. And I think we would all be much better off if we saw all of these as actual investments in real live businesses, because that's what they are. That's my view. All right. James says if the 10-year Treasury goes up, I think it was what he meant, to 5 or 6%, can the government afford the interest payments? I think the answer is probably no. Well, in theory, they could just print more money. The question would be, what would happen with inflation? I don't know. It's tricky business. There's no question about it. Eric wants to know, am I getting ripped off paying 1% to an advisor? Well, the first question is, do you need an advisor? And the answer for some people is yes, and there's nothing wrong with that. You can do much better than 1%. Vanguard Advisory Services is 30 basis points. Now, you're not going to meet them in person. There are plenty of advisors out there that will just do it on a fixed fee basis and walk through your asset allocation and should you do Roth conversions? When should you claim Social Security? What's the best approach to Medicare? And they'll go over all that for you for a fixed fee. 1% is a lot. All right. How are we doing on time? Oh, we're okay. Michael wants to know, he says Bob. I think he's directing this at me rather than someone else. Maybe not. Anyway, have you read the latest tax bill proposal out of the House Ways and Means Committee? Have you read the IRA Roth section? Roth conversions might be on the loophole radar of Congress to raise money. Absolutely true. Now, I think for most people, it's not going to affect us. The only thing that could affect most people is the mega door back Roth. The mega backdoor Roth IRA. And of course, it's just a proposal. We'll see what happens. Yeah, Ankit mentions that the portfolio visualizer gives sort of crazy compound annual growth rates when you include like a monthly investment. It does. Although relative to the other investments, I think it's still worthwhile to look at, but it does get wonky. Let's see. What else you got? Oscar wants to know my thoughts on Google, I guess Alphabet stock. I've not really fully analyzed the company. It obviously prints money. And I haven't looked at its CapEx, what it spends on, capital expenditures, but you would think relative to its net worth and cash flow, it's on the lower side, I would think. That's just a guess. The one thing that concerns me, has always concerned me about Google, is that a large chunk of its revenue, as you might know, comes from advertising, right? And powered by its search engine. And I think, what if someone comes along and comes up with a better way to do it? I guess you could say, well, that's true for any company, I guess, but I don't know. That kind of worries me a little bit. But to be honest, I've not done a deep dive on Google. All right. Greg says you do a wonderful job with your presentations. Thank you. And you obviously didn't see the first attempt, or you're just being very, very kind. Yeah, Curious Mind wants me to do a video on and sort of rebalancing, and I will do that. I think I'm just going to my list. I think I've already got it in here to do. Yeah. I'll move it over to the up next column. It's actually on opportunistic rebalancing, but we can look at both. Brandon says, hey Rob, long-term big fan of yours. Appreciate your content. Please keep it coming. Thank you, sir. John says 80% in VU, 20% in the Vanguard Tips Fund, and I sleep well. As well you should. June says that Berkshire's underperformed S&P 500 recently. Absolutely, and you would expect it to under these conditions, right? Why do I say that? What's outperformed? Growth. Berkshire, I mean, its companies are not really growth companies. They own a railroad, they own utilities, Geico, and they've got a lot of capital to manage. And Warren Buffett has said that himself. Vishal wants to know, is the market going to crash soon? Well, the answer to that is yes, although it depends on what you mean by soon. We're definitely going to have a bear market. I don't know when. I mean, it just, it just happens. What would trigger it? Certainly a rise in interest rates. I mean, we saw just a couple of days, where interest rates went up like 20 basis points, 30 basis points on the 10-year, and stocks fell. And that's nothing, right? But it could be, it could be a cyber issue that triggers something, could be a climate issue that triggers something, or it could just be, a rise in inflation, will definitely do it because interest rates will have to go up. And actually, and Powell commented on this, we've got this situation where we have inflation rising, but we're not at full employment, right? There's a lot of jobs out there that people aren't taking for some reason. And it's got people thinking, and if you're old like me, you remember this, are we headed towards stagflation, where we have a stagnant economy, but we have inflation at the same time, and it's no fun. Could be, I don't know. All I know is you want to be in a portfolio you can stick to no matter what. It's funny, you read all these books and all this stuff. They say, if you had this portfolio and you had it for 40 years, whatever, you'd do great. And we know all that. We all know that. But then we don't do it. It's like, what's the market going to do? Inflation, interest rates. We got to do this. We got to, and I think about these things all the time, but I generally don't make significant changes to my asset allocation. And when I do, it's usually for taxes. By the way, I'm going to answer a question no one's asked. Let me pull it up. I found a really cool donor advised funds. That's where you can contribute money or appreciated stock. You get the tax deduction when you make the contribution. The donor advised fund then allows you to invest it. Can't take the money out. Once you give it, it's gone. But you can invest it, and then you can give it to charities over time. So Vanguard has a donor advised fund. Fidelity does. Most of these have minimum requirements, 10 grand, 25 grand as an initial investment, but it's a great way to donate appreciated stock because it doesn't trigger the capital gains on the appreciation. There are limits to what you can deduct on appreciated stock. I think it's 30% of your AGI in any event. Adam Nash, who's one of the guys behind Wealthfront, I just saw this on Squawk Box today, has launched or is part of this, DAFI. And it's a donor advised fund, but the limits are much, much lower, and it's got a cool app to go with it. What I know about this is looking at this page. So it's dafi.org. I don't know where DAFI comes from. Obviously donor advised fund, but anyway. I think the minimum investment for stock is $1,000. Oh, no, I don't want that. I think it's here. Yeah, minimum. So it's 100, let's see. $100 will do it. $1,000 if it's stock. Anyway, I thought I mentioned that. We use a donor advised fund. Salty says Apple is junk. Philip. At some point, do you mind expanding your thought process and spreading out your investments to he says 3 or 4 brokerages? Have you found the process difficult? No, it's not difficult at all. And some of it was just, because, you have 401ks at certain places, and so it's easier just to roll it over into an IRA at that institution. But I just moved a 401k. It was a small 401k from, I think it was Transamerica, to a broker. And yeah, I had thought some paperwork, and it's done. It's easy. And my thinking behind it is, I don't know how many brokerages I'll end up with. Maybe just 2, maybe 3. But there's just part of me that says, if one of them gets hacked, I don't want them to be able to drain everything that I have. I don't know if that's how I think about it. I suppose it would add to the management a little bit, but it helps me sleep at night. So that's my thinking behind it. Okay, what else we got? Do you sell covered options on your Apple stock? I do not. And it's because I don't trade options at all. You can think of options as an insurance policy, and I don't need to buy insurance. Insurance is expensive. I have other ways to deal with risk, like being a long-term investor, being well diversified, not having any debt, having other ways to earn some income. And if I want to make money, the problem is covered call options, for example, require you to make a guess about the short term, relatively speaking. I know you can do covered calls that have expirations much longer, a year or more. But if I'm going to sell an option that's going to expire in a month or 2, I have no way to value that. I know in theory you can look at the volatility of the stock and then calculate the odds that it will go above a certain strike price, or the stocks will go up or down, and all these sorts of things. I suspect that most people that consistently say sell covered calls actually lose money, and they do it without realizing they're losing money, because it doesn't feel like you're losing, right? You get the premium, and let's say you've sold with a strike price that's whatever 8% above the current market price, and it's a 4-week call. So let's say it gets called away. I guess you could sell to close, right? You'd lose money though if the price went up. But let's say it gets called away. You think, well, that's the worst case, right? And I've made the premium plus 8% in 4 weeks. But you've sold something for less than it's worth. And so you could get premiums. You can have a number of call options that don't get called away, and you're making the premium and you're feeling good. And a year later, you get walloped one time because the stock just goes up significantly, and you've lost all your profits from the previous year or whatever. I'm just not convinced. I know there's a lot of money in options. That's the thing. Brokers make a lot of money with options, and in different ways. And then YouTubers and bloggers can make a lot of money by promoting option strategies and getting folks to open up accounts to trade options. I have no issues with people making money. I make money. I make money with advertisers. I don't really talk about them a lot. Anyway, I have no problem with people making money. I'm just suggesting that the reason you see so much coverage of options trading strategies is for 2 reasons. The money that can be made, and it's almost like sports betting. There's a casino sort of feel to options trading, because it's generally short-term trading. And people can say, well, the stock market's a casino. Well, you can treat it like a casino if you want to, but you buy something now and hold it for 20 years. That ain't a casino. So yeah, I'm not a big fan of generally options trading to try to generate income. Now, maybe you've made a profit and you've tracked all your losses, not just your losses on the premiums, and if you ended up selling at a loss, but also all of your losses when the stock got called away. Maybe you've turned out profitable, but I suspect most people have not. And then forget the taxes. Of course, you could do this in a retirement account. Victor wants to know how I break down income statements, balance sheets, and cash flows for your analysis. Well, I don't know I have an easy, short answer to that. And it's been a while since I've done a really true full analysis of a company. The last time I did it was for Apple. So my approach generally to value investing is this. I invest in companies that are well known. I'm not, fishing in the micro cap pond trying to find some company that no one's heard of that could do really well. Why? It's too time consuming, and I just don't think that's where my strong suit is. My strong suit, I think, is investing in companies that are well known, that I think are going to do just fine over the long term, but for some reason are undervalued. Berkshire is an exception to that. When I bought Berkshire, I thought it was probably reasonably priced, but I bought it just because of Warren Buffett, and I wanted to go to the Berkshire Hathaway meetings, which I've done. But when I looked at Apple, I did a cash flow analysis. This was back in 2013. So I'm looking at their cash flows. I'm seeing how they've grown over time and the profit margins, and kind of making some what I think are very reasonable assumptions moving forward and calculating the present value. Their balance sheet I looked at, but I mean, this is why I picked companies like Apple. You don't need to spend much time with Apple's balance sheet to get some comfort, okay? Because they just got, it's just phenomenal balance sheet. And, and I played with the discount rate and made very conservative assumptions. I would never use like the 10-year or 30-year yield today as my discount rate. I'd probably put it at 6% or something. Again, it's very, very conservative, and that might eliminate some companies, but I'm okay with that. So that was back when Apple was over 700. This was a couple of splits ago, and it fell to like 395. And I said, this is crazy. So I bought it. And so I look for opportunities that I just think are undervalued, and it doesn't take a lot of deep analysis to figure that out. So I invested in Bank of America last October. And I think the issue is just generally the banking industry has been undervalued, and it makes good sense as to why, given interest rates and whatnot. But I felt like that's okay. I'm in it for 10, 20 years, and it should do just fine. All right. Okay, Salty wants a video on small cap value, which is, at least historically, probably one of the best ways to tilt your portfolio beyond just following the market. And I've already got it. I'll put it towards the top of the list. I've already got it in my notes. Michael mentions SCHV, which is Schwab's value fund. Its yield, I believe, is a tad lower than the dividend fund. I want to say it's around 2%. I don't think it's done as well, actually, over the last 10 years, for what that's worth. All right. Going through your VYM is a dividend fund that let me make sure I've got this right. Scott mentions this that I talk about. I think I talk about this one in the next video. Pretty sure. Yeah, it's Vanguard's high dividend yield fund. Hakeem says, if there were a crypto ETF, would you think about having it in your portfolio? I might think about it, but I think the odds of me actually putting it in my portfolio are slim to none. I always ask myself, I did this with Bank of America, how would I feel if it went down 50%? And the thing about a company like Bank of America is it's got cash flow behind it. Crypto has nothing behind it. By the way, I wouldn't invest in currencies either. I mean, in theory, that's what crypto is, right? I know people have become very wealthy off of Bitcoin and Dogecoin, and I certainly can't deny that.
I don't have an answer for
Jesus.
that. Is there something else I can help
Siri scared the crap out of me again.
with? I don't have an answer for that. Is
Siri,
there something else I can help with?
you never have an answer. I'm glad I can entertain you because I know the chat's now blowing up over me freaking out over Siri. All right. No, I wouldn't invest in crypto. If I were going to invest in crypto, I'd probably invest in Ethereum, but that's because it seems more functional to me. Mel says, thanks, Rob. I never heard of Dividend Aristocrats. This is one toward the top of the list of the number of years dividend growth, and is the company I work for. Interesting. I don't keep their stock. Yeah, it's a thing, and a lot of folks are big into the Dividend Aristocrats. Just remember, the 50 Nifty took a nosedive like 5 decades ago. I'm not saying the Dividend Aristocrats are bad investments, just their yield doesn't make them a good investment, I guess is what I would say. Holy Smoke says, why not just write your own calls and puts? Yeah, I don't know if that was directed at me, but I gave you sort of my views on options. Bob says, I used to write covered calls to supercharge. It looks like he tracked his returns, I think, for several years, and it added nothing. I determined the market is indeed very efficient. Michael says he's not a fan of using insurance as an investment either. Late 01 says Chinese dividend stocks make sense. I own Chinese stocks through Emerging Market Fund. If you're a business owner, Keyman Life Insurance is a good idea. So in a business context, that can be a different story. And that certainly is true. And a lot of times you'll use life insurance as a way to buy out a partner. You have one policy, the first to die kind of thing. And that can make good sense. Manuel says, you scared me with the gasp. I scared me. I've unplugged Siri, though. She's done for. That's one thing, I love Apple, but I don't get it. Alexa is like 100 times better. I can't tell you how many times I'm yelling at Siri for like the dumbest things. I don't think he's ever answered one of my questions correctly. I wonder, by the way, if it's a privacy issue. I wonder if because it's Apple, the privacy settings or whatever are such that it can't do the things that Alexa does. But I could be totally wrong. Let's see, I guess me. Problem with cash is when do you go back in? I just added more money when the market is down. Yeah, if you go to cash, that is a problem. When do you go back in? My friend says his model tells him when to go back in, but he will never share with me his model. So he could be brilliant. I don't know. Salty, that is not true. He says, I have a 1% advisor now. Rob convinced me. Let's see. What else we got? So Ankit mentions, don't forget the video on 401k strategy for foreign workers. I haven't forgotten it. The problem is, I don't know what to tell you right now. I gotta research that one from scratch. Yeah, Frank, I think we had this discussion once before, and I guess I need to focus on a video, but, and I don't remember if you asked me this, but the idea was this, you know, you're going to claim Social Security down the road, maybe at 70 even. Can you take more out of your, more than let's say 4% out of your investments now, and then, you know, when Social Security kicks in, you'll be able to take out less and it'll all work out. I can tell you if I were in that situation, I would use one of two tools, and I'm going to do full videos on these tools. And these are both advertisers. I don't make much money from them, but they are advertisers, full disclosure. And I use them both. One is New Retirement, one is On Trajectory. And you can set these up so that you, for example, you can model all of this. You can say, okay, I'm going to take Social Security at 70, fine. And from whatever, 60 to 70 or whatever the case may be, I'm going to spend this much. It's 5 or 6 or 7% of your portfolio, whatever it might be. And then when Social Security kicks in, I'm going to lower that because I won't need that much. It'll be whatever. And it will sort of crunch all the numbers. New Retirement has a Roth conversion tool that will give you their view of whether you should do Roth conversions. On Trajectory has a neat tool that gives you some ideas as to what order of the accounts you should take your money from. I think New Retirement's working on something like that. But I think that's what I would do. I would model what I want to do in a tool like that. I've mentioned Personal Capital. The good thing about Personal Capital's retirement planner is it's free. New Retirement and On Trajectory both cost money. I think they're very reasonable. The problem is you could still probably model some of this in Personal Capital, and you could try it, Frank, but On Trajectory and New Retirement are going to give you much, much more flexibility. So John asked a really good question. He says, just rolled over a 401k to an IRA a couple of weeks ago before the drop. Invested some, but still have half in cash. Any suggestions how to get back in or how to park the cash safely until getting back in? Well, I can start with the second question. I mean, you could just keep it in a money market fund or a short-term treasury index fund. I mean, that's certainly safe in the sense that you shouldn't lose the dollar amounts. I mean, obviously, the income you'll earn will be less than inflation. So you'll be losing purchasing power. But I mean, those are reasonably safe ways to park money. I talked about this actually in two different videos. What I did in 2018 when I had money to invest, I just lump summed it. That's just, if you look at the history, you're more likely to do better off with a lump sum because in most years the market goes up. What I haven't seen is a study that says, well, let's only look at it when markets are really expensive. In those, you know, when the PE is 20 or higher, let's say. In those years, am I better off lump sum or say dollar cost averaging over a year or whatever? I haven't seen a study like that. If anyone knows of a study like that, I'd love to hear it. In a more recent video, I said, look, the markets are so high, it may help some of you to take comfort by dollar cost averaging, say over a year, as an example. I think that's fine. I don't, you know, if you're asking me which one will be better, I can't tell you that, right? I mean, because I would need to know the future, and I don't know the future. I'm trying not to skip any questions. There's a lot of back and forth today about individual stocks, which is kind of interesting. Oops. Where'd it go? Here we go. So Carp Diem says, I recently started using one of the big wealth management firms that charge 0.8% of total assets under management. I'm trying to benchmark their performance versus if I was just investing in ETFs. Well, I mean, if you simply replicated their investment strategy, you'd also have to replicate rebalancing. Then you know the difference, right? 80 basis points. The question is, do you want to manage it yourself? And will you stick to the asset allocation in a really bad market? The thing about that question is you got to remember that when there's a really bad market, there are other things going on in the world that scare the crap out of us, like a pandemic or a financial system that seems like it may go belly up, and unemployment going up, and or it could be a war. There's bad things going on. And so it's not just weathering some number on a computer screen. It's managing all of the emotions and fear that come with going through difficult times. So that's just something to keep in mind. Giles says, thank you so much for your videos. Helps me so much finding the right decisions. Greetings from Austria. Thank you. Well, back to Carp Diem, you could use something like Portfolio Visualizer, and you may need the paid version, or actually Personal Capital will do this. You can put your portfolio in Personal Capital, and then go to the fee analyzer, and then model what the cost of the advisor fee would be over time. So let me just show you that real quick. And I'll show you my screen in just a second. Two-factor authentication. I told you I use this. And this isn't even my account. This is a dummy account. All right. There we go. So this is a dummy account with 3 portfolios in it. The total, what, $3 million bucks. You'd go to Planning, Retirement Fee Analyzer. Oh, do you have to link? No, you shouldn't have to. Oh, I guess because these aren't linked accounts. That's interesting. Oh, it's account type. That's the issue. So if you, let me just show you what I'm doing here. If you hit the little pencil over here, I don't know how well you can see it, but whoops, try that again. If I call this a retirement account, oh, whoops, whatever, 401k. My goodness. Rob Belinda, how did that get in there? Anyway, oh, traditional. Whew. Now let's see if it'll let me do it. So this is the weird thing. So now it lets me do it because this is a retirement fee analyzer, right? But I can come over here and I can include all the taxable accounts if I want as well. So I guess you have to have at least one retirement account, and these are manual. By the way, I've heard some say that you have to link at least one account. When I created this dummy account, I actually linked my M1 Finance account where I invest our credit card rewards. I've since removed it, as you can see, and so it still allows me to use the tool. So maybe you link some small IRA or something for those of you that don't want to link your accounts. And then you can create manual accounts and then remove the linked account, I suppose. But in any event, so for these 3, the annual fee is 63%, or 63%, 63 basis points. And what you can do down here, I wonder if that's because of this. Let me look. It's because I already had this. So it's 13 basis points. And then in your case, you can come down here, additional investment fees. This would be like for an advisor. And I get it close and I use the arrows on my keyboard. There you go. And the nice thing is it not only shows you your overall expense ratio, but then, now this is only showing you from age 61 to 62. It's because of my assumptions. If I say I'm going to retire at 61, but let's say I was born in 1990, now I'm only 31, and I'm going to retire at 61. Total fees paid would be $6.5 million, which may strike some of you as unbelievable, but that's correct because we're investing for 30 years. We're starting with $3 million. We're assuming a growth rate of 7.5%. And so anyway, to answer your question, Carp Diem, you could use that tool as well to sort of model. The thing I like about it is it just doesn't just show you your expense ratio, but it projects it forward based on some assumptions. And of course, you can look at different annual growth rate assumptions and everything else. All right. Howdy says, just my opinion, I think DGRO is superior compared to VYM, has better growth with similar dividend yield. I just want to see if I used that one in my video. No, I didn't. Oh, yes, I did. So DGRO, I cover that in my next video. It's on my list of one of the 5, what I think are one of the 5 best dividend funds. Really 5 best. I hate kind of doing those sorts of videos because it's kind of silly to think these are the 5 best for everybody. There's no such thing. So take all that with a grain of salt. I should have said, I think these are 5 decent dividend ETFs. But no one searches. Who goes to Google and says 5 decent dividend ETFs or YouTube? People don't search for that. They search for the best. Why not? So Michael actually makes 8% on BlockFi, stablecoin. Well, good luck with that. I tell you, you know what could tank the market is if a stablecoin blows up. Thoughts on the dogs of the Dow strategy? I'm going to do a video on that. This is from Alex. I'll add that. That's a good topic. In concept, I like the strategy. I've never followed it, but because it's basically a value strategy, right? You're investing in the underperformers. And what performed well last year typically doesn't perform great this year. See ARK. Let me see if I can show you something which many of you have probably seen before. Here we go. If I can get this big enough where you can see it. Well, it's not real big, but you see these charts, asset classes. This is old. But, you see like in 2003, it was emerging markets. Then they did really well. Look at that. For 5 years, they were first or second. Then, boom. I remember that. That's not, and then they're back up to number 1. And then down, up, no, down. Yeah, that's what they do. So it's interesting that international stocks did so well. Of course, emerging markets. I don't know if this asset class is just developed countries or if it's the whole international market, but yeah. So this idea of buying, it'd be interesting to see how a portfolio would perform if each year you allocated all your money to like the bottom 3 asset classes. Anyway. Salty really does not like Apple. I've learned that today. Here's a good question from SAI. If I have enough money in personal stock to pay remaining mortgage on a house, should I pay it now before interest rates raise and my stock values go down, or just pay off later since I have equity? Well, yeah. So there's a couple of ways to analyze this. One is just to look at the numbers, and most people would say, assuming you have, interest rates of 2 or 3%, that you shouldn't pay it off early, because even if stock market goes down a little bit soon, long term it's presumably going to do better than 3%, and you'll be better off in the long term. I certainly can't argue with the math and history. The flip side is, what helps you sleep better at night, and how comfortable are you effectively investing money that you've borrowed. Now, I do not for a minute think that not paying off your mortgage is the same, for example, as investing on margin. They're 2 totally different things, and people, I think, kind of get a little too cute with that idea. I can tell you what I did. We held the mortgage for a long time, then I started paying it off in chunks, but not all at once, even though I could. And then eventually it was like, yeah, I'm going to pay it all off. Now, had we not done that and invested the money, we would be wealthier than we are today. Whether we would be wealthier than we will be a year from now, I don't know. But I'm comfortable with that decision. So the long and short of it is there's no one right answer. I would look at overall liquidity. I would look at the tax consequences of selling stocks, presumably in a taxable account. I would, of course, factor in your interest rate, but I'm going to assume it's really low on your mortgage. And it's not all or nothing. Maybe you keep the mortgage, but you pay it off faster. I don't think there's one right answer. All right, I'm going to have to bring this show to a close here soon. I'm just trying to look through here. Michael says, Rob, is the worldwide adoption of crypto and the fact that the largest up-and-coming millennials generation are embracing crypto no reason enough to allocate some portion to this new asset class? Not for me. We'll see what it does. I mean, right now it's highly correlated to the S&P 500. But not for me. But I don't invest in gold either. And then you can make the case for gold. I've done that in the past video. What else we got? Do I think decentralized currency will acutely aggravate recessions and bear markets? No, because I don't think, well, I shouldn't say ever. First of all, we don't have decentralized currency now, right? Bitcoin is not a currency as a practical matter. I understand you can buy some things with Bitcoin, but it's not a currency. And in fact, if it ever is a true currency, you'll lose your interest in investing in it. You won't want to invest in it any more than you want to invest in euros, right? Because for it to be a currency, it's got to be stable, to be a useful currency. But I don't think governments will allow it. I mean, look what China's doing right now. No, I mean, other things might cause bad recessions and bear markets. I do think if something like Tether blew up, it would roil markets. That would be bad. Stephen, I'm not familiar with Blackstone Real Estate Income Trust, BREIT. I can look it up real quick. Is that ticker right? Huh, it's not coming up in Morningstar. I don't know. That's a new one for me. I think Fast Eddie's asking a question about personal capital. Does that show your fee growth if they did not take it out every quarter? And I don't know the answer. How else would they take it out? I think they most take it out quarterly. I guess they could take it out annually. I don't know what assumptions personal capital makes. If they do it annually or not, I'm not sure. Carlos says, late to the party, but I assume you've already covered why dividend investing is bad. I have, but as soon as this is over, which is going to be in a couple of minutes, you can rewatch it. It's like the first. And by the way, I deleted the first video with no sound. Although that could have been my better one. By the way, I heard my wife on the porch yelling at a car going by to slow down. But anyway, as soon as this is over, you can rewatch the video. Alex says, thank you, Professor Berger. You're welcome. I'm almost to the bottom. I'm trying to get to, okay, no one say anything else in the chat. I'm almost to the bottom. Okay, oh, there's more chat. Stop it. A lot of you guys like paying off your home. I mean, it gave me peace of mind, but at the end of the day, it's my overall financial picture that gives me peace of mind. You could pay off your home and not have any money left, and you won't be financially free. Salty says, no chess today, fine. I'm going to give Salty a chess problem. No one answer it but Salty, and it ain't going to be easy. Here we go. We'll do puzzles. Well, that's interesting. Oh, how hard can that be? Just 4 pieces on the board. All right. It's interesting, Michael, about whether Bitcoin is a security. I absolutely think stablecoins are a security because they're backed by securities. cash in part, but that's the whole mystery of what's backing Tether or USD coin or all that stuff. But Bitcoin itself is kind of interesting. I don't know that would be classified as a security, at least from a sort of technical legal perspective. I don't know if anyone's ruled on that. Alejandro says, "Hey Rob, I wish your neighbor greetings from Alabama." Well, thank you. All right, that's it. The chat's over, so we're going to look at this puzzle. Anyone? I haven't even looked at it. Let's see here. So a queen should beat a rook, right? We know that. And we got the white king trapped in the corner, but the rook is attacking our queenie. And we don't like that. So how do we deal with it? Boy, that's tricky. Huh. What have you got? No one's answered this one. Come on. I mean, there's still 150 of you on the show. Someone's got an answer for this. I'm having trouble with it. And you're welcome to everyone. Thank you for the show. I am going to turn this thing off as soon as I solve this chess puzzle. What do we got? We got queen b5, queen b6, queen c6, force a fork in some way, queen b5 check. The question is, what's the follow-up? Right? Because you've got two checks, right? Queen d8 and queen b5. Well, you could check other places, but you'd lose your queen. The follow-up, I think, has to involve getting the black king involved. I'd love the black king to queen. I'd love the black king to be on c6, because then I have mating threats. For example, if I play queen b5 check, and if white played queen a8, then I could play queen c6 and white's in trouble, but he's going to play king c8. So I'm thinking, here's my thought. Queen b5, king c8, queen b6. The only check white has would be on rook d7, where my queen sits. But then I could play king c6, and he can no longer check me on c7 because I can take it with the queen. Okay, that's what I'm going to do, and we'll see if I'm right. It tells you right away, by the way. Here we go. Oh, wrong. So there's got to be, I think it's got to be that. I don't know what the follow-up is. That. Then that. And then that. Yeah, well, then I can just take. So, seems easy once you see it, right? I mean, how hard is this? So what I was looking at, so this is now the computer's analyzing it. I was looking at this. Is that a draw? That's a draw. Of course, you can just play rook b7. Isn't that amazing? Didn't even think of that. I don't know how I didn't think of it. That's what I love about chess. Totally, the complexity is unreal. And that's right, that's a simple position. All right, gang. Thank you. As always, I enjoyed it. I'll be back, God willing, next Thursday at 11 a.m. Till then, remember, the best thing money can buy is financial freedom.